Corporations legally moved billions in profits to tax havens, and governments wrote the rules that let them do it. A patent box is a legal mechanism, not a loophole, at least not technically. It's a tax policy that allows companies to pay a significantly reduced rate on income derived from intellectual property, patents, trademarks, software, brand names. The Netherlands pioneered this in 2007. Within a decade, Ireland, Luxembourg, and France had adopted versions. Today, over 30 jurisdictions offer them. What makes this a system rather than an accident is that these countries designed them deliberately, knowing exactly what would follow. Exhibit 1, the math. A pharmaceutical company develops a drug in the United States, paying full corporate tax. Then it licenses that patent to a subsidiary in the Netherlands. The Dutch subsidiary pays a royalty, sometimes 10, 20, even 30% of revenue, back to the U.S. parent. That royalty is a deductible expense in America, reducing U.S. tax meanwhile. The Dutch subsidiary's income from that patent qualifies for the patent box rate, often 6 to 9% instead of 30. The profit that would have been taxed at full rate in the U.S. is now taxed at a fraction in the Netherlands. Exhibit 2, the scale. Between 2009 and 2018, multinational corporations shifted an estimated $800 billion in intellectual property income to low-tax jurisdictions. The OECD and IMF documented this. These weren't criminal schemes, they were statutory strategies. A tech company's software division could report earnings in Ireland. An automotive supplier's engine patents could live in Luxembourg. The IP moved on paper, the actual innovation happened elsewhere. Exhibit 3, the feedback loop. As countries watched revenue drain, they faced a choice: raise rates on labor and capital, or compete by lowering IP tax rates further. Most chose competition. This created a race to the bottom, predictable because governments operate like firms in a market. When one cuts, others follow or lose investment. By the mid-2010s, the system had calcified. Corporations had engineered the very rules that governed them. The reason this persisted so long is systems thinking. No single actor was breaking the law. Each jurisdiction was sovereign. Each company was rational. But together, they hollowed out the tax base in high-wage countries and concentrated wealth in jurisdictions with minimal public services. The cost was diffused, felt as budget cuts, underfunded schools, deferred infrastructure. The benefit was concentrated, captured by shareholders and executives. That asymmetry is why the system proved so stable. Around 2021, the OECD proposed a global minimum corporate tax, 15%, partly to address patent box arbitrage. Over 140 countries signed on. Implementation remains uneven. Some jurisdictions narrowed their patent box rates, others added restrictions on IP transfers, but the fundamental architecture remains. Intellectual property can still be taxed at a discount, and it can still be moved. The system adapted, not collapsed. This wasn't a conspiracy, it was a structure. Governments created tax incentives to attract IP-intensive firms. Corporations used those incentives. Accountants and lawyers built the bridges. Economists predicted the outcome decades before it happened. What looked like clever optimization was actually the system working exactly as designed, just not in the public interest. That's the distinction worth holding. The rules were legal. The rules were also chosen. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to uncover how systems designed by the powerful reshape markets and policy. You'll find a new mechanism dissected every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.